So, hi everyone. I'm here with Stuart Murgatroyd here today, who's the CEO of Data on Demand. Stuart, thanks very much for joining me. I really appreciate it.
Thanks, Chris.
Stuart, do you want to tell us a little bit about Data on Demand and what you guys do? I think that'd be a good place to at least kick off.
Yeah, of course. Yeah. So we provide data and insights to companies that service consumers, better helping them understand those people. We've got two products, FinTrace, which is for collections and recoveries, and a product called IDView for identifying vulnerability.
You're in the data space and sort of collecting lots of information from different sources and then providing that back to clients. What are some of the things you're seeing in terms of changes in terms of what clients are asking for and how that data sort of being gathered and then being ingested?
Yeah, I mean, we're not reinventing the wheel, and this isn't rocket science. Where we're different from the other kind of incumbent traditional providers like the CRAs is that we're sourcing different types of data. In particular, we have relationships with a number of high-cost short-term lenders and affiliates that drive traffic into those particular, what used to be called ping trees, but that's not a word that people like to use anymore. But it's still the same thing. You're trying to find the lender that will lend to the individual who requires the loan. So in terms of what a client's looking for, they're looking to be able to either contact more people for collections and recoveries or identify people who are currently vulnerable. And those are really the main asks at the moment from our clients. What we're seeing, though, in terms of the change in the data is the insights that are available to us and then available to our customers. So it goes beyond just contact information. It goes deeper now, being able to take information from loan applications that is information that is seen before it goes to a credit reference agency that gives you lots of insights around a person's financial behaviour, and before it gets to a credit reference agency because it's application data.
We had a conversation before around financial vulnerability and sort of using data to be able to determine some of that. I thought that's quite interesting, particularly as we get into this digital world. Is like we're looking for ways to almost like get to customers quicker who might be in difficulty to offer support. I mean, what's been your sort of insight around that? Because that's always been a challenge in terms of trying to go back and getting people on the phone.
Yeah, absolutely. Yeah, it's a challenge, and it's certainly a hot topic at the moment. And I think, we've had the guidance on the vulnerability that's come out. We've had the financial life survey that was finalised, and what people are really waiting for now is the final version of the consumer duty, the new consumer duty, which I think is where people will then firms will start to act more. At the moment, they're doing lots of research and looking at what are the other ways that we can find or identify vulnerable customers outside of the traditional data sources, which really is just the CRAs. Although you do have the VRS, the Vulnerability Registration Service, who we partner with, and that's a pot of data around about 500,000 people. They've got self-declared vulnerable individuals. What we bring to the table that's different is the high-cost short-term loan data that creates our IDView product, and there's 2.5 million individuals on there that have taken high-cost short-term loans. It's a very new product. We only started building the database in July 2020, and over that period of however many months that is, less than 2 years, we've seen 2.5 million people apply for loans. But the interesting thing is that every month we see around about 500 to 800,000 applications, and of those applications, there's 50,000 to 80,000 that are brand new, never seen before. So you've got the same people coming in again and again and again and again, and these are vulnerable people. The FCA in the Financial Life Survey, they created the characteristics of vulnerability, which are bereavement, income shock, low or erratic income, caring, relationship breakdown, over indebtedness, and low savings. And what we've been able to do is take those characteristics and use the data we've got in our IDView database to actually map those back to an individual level. So some interesting statistics from last month, from the data that we've got on the database, we saw 16,104 people who needed to borrow short-term cash. That was the purpose of their loan. We saw 37,981 people who needed to borrow money from a high-cost lender to pay their household bills that month. Now, I mean, 37,981 might not sound like an enormous number, but if you're British Gas and you want to match that back to your customer base and just identify a handful of customers, that's people you can help.
Yeah, and I suppose just looking at the affordability crisis, I suppose, which was talked about really at the start of the year.
Yeah.
And we were just chatting at the start there about how energy prices, even just recently, I mean, they've even exploding further, like, because there's still more to go on that. I mean, I imagine there's insight there in terms of that population could grow further, and I suppose it comes back to the efficiencies in terms of how you're working those accounts, how you're sort of helping those customers.
Yeah, absolutely. I mean, what will be interesting for us to see is this: if there is a spike in people borrowing money to pay their bills, because we've got the history of the information over from the past 2 years, then we'll be able to spot those trends actually in terms of the growth in applications for those reasons. And I think the energy crisis, I'm waiting for my direct debit to go up. It hasn't yet, but it's around about the 18th that my bill goes up. So I'm interested to see in the next few days how much they actually hike that up. The problem is really that there's the BBC article out the other day actually about everything that's going on at the moment in terms of the consumer credit crisis that is happening on the back of Ukraine and the back of the pandemic. And it's the middle income to the low income families that are certainly going to suffer from this. We talked about we did a piece actually. We did a seminar with the CSA probably 6 months ago about the tsunami of debt that we expected to see as a result of the pandemic, and I published something on LinkedIn a few days ago. We just haven't seen that. We haven't seen that wave, if you like, of debt yet.
It was almost like through COVID. I mean, a lot of us were expecting the tsunami of debt, and it was sort of, we work in collections, so we sort of like we're looking out for it, right? And it really didn't come through, I suppose, because of the government support and some of the things. And it's almost like, I suppose, I mean, do you think we got a bit of a fear that almost like there was a bit of almost like crying wolf the first time, just in the general perception that now we see this coming through? And I would agree. I think there's a risk that people are going to take their eye off the ball. I mean, before all this, I mean, there's definitely a little bit of sort of opening the books to try and get more lending through, I think, on the front end. You got any thoughts on that, or do you think we're going to be ready?
Well, I think you look back at what the government did, and there's the two main things, which is furlough and forbearance. So businesses were able to pay people without them having to go to work, and people were able not to have to pay back debts, and they had breaks, which is great, and it allowed a lot of people to catch up and get back on top, and avoid that massive amount of debt. But moving forward, we're entering a different kind of crisis now. We see food inflation at the highest rate it's been since September 2013. I read on the BBC's website. There's other things that you don't think about that will have an effect. The rising price of secondhand cars. It's going to create a bubble, a bit like the housing crisis, the housing crash did, because you've got people who are buying cars now that are 25% above market value, current or pre-market value, pre-pandemic, and pre the shortage of the supply of those vehicles. There's people who are financing those vehicles. Not everyone buys the car outright. So you're now financing a vehicle that's 25% above market value, and actually you've probably got that finance for 3 to 5 years. In 3 to 5 years, the production will find its feet again, and the price of those second-hand cars will reduce. People are going to be left with cars that they've got massive amounts of negative equity, and there's things like this that we don't think about that are a result of the pandemic and moving forward through that. So I think
you like get a double whammy. You get like a double whammy.
Yeah.
You get a double whammy. You pay more for it, and then it's then gone down in value when you then come to sell it. So you sort of like you lose on both ends.
Exactly. At the moment, people's second-hand cars going up in value, which is great if you sell it now. But you're still in. It's that chicken and egg of, well, if I sell it at a higher price, I've got to buy one at a higher price, and like housing prices at the moment. And will that be a similar thing? Housing prices have increased massively. We had the Help to Buy, but also the stamp duty reduction as well. There was a surge of people buying houses, and actually money's cheap at the moment. Borrowing money from high street lenders at 1%, 1.5%, 2%. It's a great time to borrow money, but people are only fixing those deals for kind of 2 to 5 years. There's not
Mm.
many people that are fixing them beyond that period. Again, what happens then if interest rates do go up and you've pushed yourself to borrow more than, well, you could afford it at the time maybe, but if the interest rates go up for your mortgage, if food prices go up, if energy bills go up, if all of a sudden now you're trying to finance a car that's not worth the value it should be, then.
And are you starting to see any of that stress in your data now, or is it still sort of relatively benign? Because I think it's fair to say it's been relatively benign, I think, much more than we expected for sure over the last sort of 18 months. I mean, we didn't see that, but some indications around, are we starting to see that return to normal or even starting to increase? Have you got any indications of that yet, or we're still in the wait and see mode, do you think?
The wait and see mode. I mean, we've done some work recently with a car finance provider with a small book of 10,000 customers, but of a huge value of actually money that's been lent. And the IDView product is great because what they gave us lots of data and gave us the information about how much each person had borrowed. So we're able to then categorize that into certain bandings. Also, they're telling us who the good payers are right down. So you got currently paying good customers all the way down to then 1 to 12 payments behind. What was really interesting for us to show to the car finance company was you've got your good payers, but actually we've identified a small proportion who we would categorize as highly vulnerable. They've lost a job, they've reduced their income, they've suffered a relationship breakdown or bereavement. And these are people that the FCA would classify as highly vulnerable people. There are even more people that look like they were vulnerable. So it's what you were talking about. It's being able to identify those individuals to take action before they can't afford to pay the repayments anymore and service those loans. So it's using the information we've got right now before it's too late. That's right.
And operationally, how does that sort of translate into action? Do they sort of use that as almost like that pre-arrears conversation, or almost like it's like we've got some information that can actually be helpful in sort of like heading off some of these issues? Is it sort of like providing those nuggets from a, almost like a pre-delinquency, pre-arrears type information to set them up and then have the conversation? Is that typically how you've seen it being used?
There's 3 reasons why people want to use this data and kind of need to use this data. One is the credit risk element of it, and the credit risk director wants to know how many of these people who are currently paying do we think will not be able to pay from the information we can get that isn't coming after the event, after a missed payment, after a CCJ. This is saying right here, right now, we know this person has applied for a high cost short-term loan. They can't get finance for what they need anywhere else. So there's a credit risk decisioning of your current portfolio of customers. Then you've got your compliance person who wants to make sure that they meet their obligations to the regulator, who's saying you need to find more vulnerable people, you need to identify vulnerable people, you need to take action. And then you've got the vulnerable customer manager and the whole ethical side of it, of you should be providing better outcomes for your customers. So it's all about using the information for credit risk, regulatory obligations, or also creating better outcomes for those customers.
And maybe just talk a little bit about, I suppose, GDPR and privacy and those kind of things, and something like how this is sort of like covered by that. And it's sort of like, in terms of the data processing piece.
Yeah, so that's just interesting actually. So what we from the very, very start, from the outset, we wanted to ensure that we were absolutely compliant in terms of GDPR. And you've got to give the individual a notification at the point of data submission about what you'll be doing with their data. A fair process and notice, which is some wording which explains to the consumer what's going to happen to their data. And then there'll be a link to a privacy policy with a lot more information in that privacy policy. So what we did when we started off building out IDView and FinTrace, the collections product, we made sure that in every website that contributes to our product, then there's wording that we have in the fair processing notice. Data on demand is hyperlinked there as well. There's also a hyperlink to the privacy policy, and importantly, the individual has a hyperlink to be able to opt out at that point as well. It's really important that you give the individual the opportunity to opt out of the processing. The privacy policy explains very clearly why we use the data and for what purposes. And the individual's notified at that point. It's a bit like tracking back the meat in a supermarket where where your steak came from and you pick it off the shelf and you go, it came from the farm in Norfolk on the 7th of November. exactly the same with us. If a customer or a consumer data subject says, well, where did you get this information from? Then we can track right back to the origination of
This
that
one here, yeah.
submission, which is great, which is really good. So it's compliant. But the other thing is that we're only working with companies and we're only building products that create better outcomes for customers. The debt collection product means that, although people see debt collection, oh, it's a dirty word, debt collection, it's horrible, you shouldn't be collecting debts. Actually, the better outcome from the customer is that person that's got a big pile of debt here, well, it's going to be purchased by someone else. They're going to spread that cost out, potentially reduce it, and they're going to ease that person's financial struggle, which is great. With the vulnerability stuff, then again, you're identifying someone who's currently vulnerable. You're giving information back to a service provider to say, you can help this customer. Not only can you protect your own business with credit risk, and you can do what you need to do for the regulator, but you can do what you should do as a business, provide better outcomes. So the data, you've got to be compliant with the data that you're supplying.
And so you talked about your current data sources, and you're getting it through loan applications and some that sort of transparent process. But do you see there's other sources of data where you could get information that could also be useful, and is that sort of like an area where you think we're going to see expansion?
Yeah, I mean, I think Call Credit. I was calling Call Credits TransUnion. When I worked there, it was Call Credit. TransUnion, for example, have recently announced that they're taking in a lot of the buy now, pay later data, which I think will be really useful. So that's another source of data that's out there that will certainly be useful for collections and for vulnerability.
Wasn't it also things like Netflix subscriptions and some of your subscription services as well that I think was also being ingested?
We're not doing any Netflix stuff. I mean, you could take that kind of information. There's got to be a certain level of expectation from the consumer that the data would be used for the purposes, and also there needs to be a notification at the point of data submission or data entry for the purposes of the processing. So actually, anyone could take any data from anywhere as long as the correct permissions were in place to use it for the purposes. So we've got a huge database. I mean, at the moment there are 25 million addresses, 35 million confirmed individuals. There's 25 million mobile numbers, 31 million email addresses, 16 million landlines. So I've just got it down there. I can never remember the numbers. They change. Always going up, but they change.
And I suppose, what's your view as we sort of amass the data on potentially on customer databases? I mean, how far do you think it can go in terms of automating and being purely digital versus the role of the human in terms of gathering some of the information? You're obviously gathering information digitally, it's sort of sitting in your database, but there's also within operations, obviously that's a data gathering exercise as well. And where do you sort of see the balance, or the almost like the symbiosis, I suppose, of the working together of like the digital and the human?
So I think you're always going to need the human touch with debt collection and vulnerability. At some point, somebody's going to need to speak to somebody. Where I think the connection comes in is actually creating the contact, creating the engagement with the individual. So if you've only got postal information and the person that you want to contact isn't opening letters, then you're hitting a brick wall. But if you can append a mobile number or an email address and they get a text message and they can open that, and it takes them to a landing page that tells them a bit more, it's personalized, it's explaining to that individual about how the service provider could help them, then that would certainly be useful. I think for vulnerability as well, there's a lot of people have written about this, and a lot of people will agree that a lot of people will not admit or think or want to admit they're vulnerable. The data identifies the fact that they are, or they could be, or they're emerging as vulnerable. So actually, being able then to take that digital information from the application and add an SMS and send a text message to that person to say, we can help you, this is what we can do for you, then that would potentially can create more engagement. So I think it's the connection between. You can't have a digital proposition without having a digital contact channel.
What I find quite interesting is almost like you have those direct indicators around vulnerability, but then you also have indirect indicators. They might be 2 or 3 steps removed, but they're also predictive as well. And what does that mean in terms of vulnerability or potential vulnerability? And that someone might be potentially vulnerable, I would say, and sort of starting to build that up. And that feels like we're almost like starting on that journey as much as here's the flag over here, here's the action. It's almost like this might be true, so let's flag it and then find out and get the extra information. I think that's fair.
I think that's fair, and I think that's fair because it's for, especially when talking about the FCA as the regulator for financial services, then they've done this flagship survey for the financial lives, and they've come up with the characteristics of vulnerability. That was an incredibly expensive survey and an incredibly in-depth survey with incredible reference points, and a great survey in terms of identifying those characteristics of vulnerability. Being able then to map those back to your individual customers, then we're not saying it's an indicator, Chris, just like you said. It's this person. The FCA have said that someone who has an income shock is someone that has lost their job in the last 12 months. If we can tell you that someone had reduced working hours or lost their job, they went from employed to unemployed in their loan applications in the last 3 weeks, that's the time to actually talk to that person. Not having that information and not being able to speak to that person at that point to understand their current situation means you miss that opportunity. And it's not until the credit reference agency 6 months, 12 months down the line report the CCJ or the arrears, or the person stops paying and you pass it on to a debt purchaser, you've lost the opportunity to do the 3 things we talk about, which is reducing that credit risk, obligations to the regulator, and getting the better outcome from that customer at the point of understanding. And an application for a short-term high-cost loan really is a cry for help. It's someone putting their hand up saying, I can't get finance at a decent rate. No mainstream lenders want to lend to me. I haven't got enough savings to pay this bill. I haven't got friends or family who can lend me this money. But I need some help, and I need it because I need 100 quid to pay my gas bill. It's a really great indicator of someone's emerging vulnerability.
And I suppose, what about the work environment in terms of the business environment, and how are you sort of like seeing that change? I mean, obviously, we talked about 2020. We've been in sort of like this sort of hybrid sort of like lockdown versus in the office versus, out at conferences versus doing things remotely. I mean, how have you sort of seen that change, and what do you sort of think is going to happen going forward?
It's interesting, actually. Our office is in the city centre of Leeds, above the train station, so we couldn't be any more central. I drive into Leeds. It's 17 miles into Leeds from where I am, so I'm a little bit further north, and I go into Leeds. And typically, if I left home at 8:30 to get into the office, it would take me an hour and 15 minutes. I can be sat at my desk in 25 minutes now. There's certainly not as many people going into offices as there were before, and you can stand at the window of our office and look onto the front of the train station, and it's not busy. There's not as many people there as there used to be, so it's certainly quieter. I spend a lot more time working from home now than I did before, but nothing's back to normal. The Russian-Ukraine war at the moment is going to make things take longer to get back to normal as well. The sentiment that's out there is still, one of nervousness, and you look at the stock market and everything that's happening there as well. We're still on a shaky ground, really, and it's going to take a while for everything to get back to normal. And I don't think that life in the office will ever be the same.
I was in London the other week, and I was definitely noticing a Friday lull. If I just compare it to where it was sort of like 3 years ago. I mean, I used to have trouble parking. I had to get there really early to get a parking spot. And these days, you get there quickly. You can get a parking spot. There's hardly anyone on the train. And I didn't know if that was just a Friday thing versus people sort of like working from home at the Friday and maybe Monday versus like a wider kind of shift. It does make it a lot easier to get in, doesn't it?
I'm on a train to London on Tuesday for my first trip to London in a while, so I'll let you know if it's any different on a Tuesday to a Friday. But you certainly see in the office in Leeds, Mondays and Fridays are quieter days.
Yeah,
that's definitely the working from home days for people.
And I suppose the question is, does it matter, right? So for us, does it really matter? And I mean, and I'm not sure how much it does. I mean, we're doing this via video. I mean, do you finding that clients are much more receptive to it? And the other thing I've noticed is meetings become smaller as well, shorter. You can bounce between lots of different ones.
You can get more people. I've had more virtual meetings where more people are available on those calls. You know, because it's easier to get everyone on a video call than it is to get everyone to Nottingham, if that's where you're meeting people. So that's certainly been interesting for a new business like ours and a startup, really. Then taking out the cost of attending meetings is useful, because rather than the trip to London for one day that, you know, can be expensive, you've got 3 people on a call and it takes half an hour, like you said. I think, I don't know if it slows the whole process down a little bit, or whether you get more attention or buy-in from someone when you meet them face to face and agree things. It's difficult to say whether that is a result of face to face versus virtual, or just a result of the market's slower than it's ever been because we're still coming out of the pandemic. And you look at the debt collection business, the debt purchasers, there's not as much debt for sale. They're not buying as much debt. The banks are more nervous in selling it. So, you know, that there's a knock-on effect in terms of things perhaps being a little bit slower in how long, say, contracts are taking to come to fruition.
But it definitely feels like almost like you whereas before you'd meet people, build the relationship, and then you'd do the business. It's almost like build the relationship online first, and then you sort of reinforce it, I suppose, by meeting face to face.
So I mean, it's always great to get a face to face after that. It's almost like a first date. You know, you do the first date, and did it go all right or not? Can you move on to a second date, the face to face? Which is interesting. But I think what's interesting about the whole virtual thing is, if I went back to February 2020 and I'd spoken to a client, sent an email to a client, said, I've got something really interesting that we should talk about, and they said, yeah. And if I said, let's set up a video call, if you could get your ops director and your collections manager onto a virtual video call, what do you think? I think they would have gone, no, I don't think so. That's a bit strange, Stuart. Come to the office. Get a camera off. So people are more accepting.
It does feel like it. It does feel like it's improved the speed of things and which things can be turned around. Although I do have a bit of a sense that it's subtly changing a little bit, really, since the start of this year, where it's sort of like and people have sort of struggled a little bit between in-office meetings, where you had in-office meetings versus virtual meetings, and it's been a little bit of sort of like the time pressure. You can feel the time pressure changing a little bit.
I think so. I would agree with that. Our technical guys have loved this period of time because they just love working at home. Only coming into the office once a month is a dream come true for those guys. But I like being in the office. We recently recruited a couple of new business development executives who are booking appointments and speaking to prospective clients. They're in the office every day. But then they're in their early 20s and they don't want to be sat at home. They want to be in the office. They want to be in the city centre. You know, they want to go out at lunchtime and have a walk, get some food, and meet their girlfriends after work and go to the bar and that kind of stuff. They don't want to be sat at home.
It's interesting how it's changed. So where do you think we go from here, though, with all the talk about data and sort of expansion of data, the stuff that you've been doing in terms of like using data really to sort of inform processes, I think, and inform actions on customers. But where do you think it goes from here? I mean, what's the future look like? I mean, data's being talked about everywhere, but what's next?
Well, I think we've got to change the future, and I think we change the future by introducing data that isn't currently available, and finding new sources of data that perform better, that give better outcomes, not only for the debt collectors and the people who are looking for the vulnerable customers to satisfy their own needs, but also to create those better outcomes for the customers as well. I think what you've got 3 incumbent CRAs who've dominated this space for a long time, and people who use those businesses, they're great. I used to work for one. They're fantastic businesses. They do a very good job at what they do. But changing the future is about identifying other companies with different data sources that can bring something new to the table. Something interesting. We were, I won't name names, but we got to the final of becoming a fintech partner for
Mm.
a large organization that run these kind of cohort programs. And the reason we didn't actually get onto the program was that although our product was innovative, although our product was actually showing a huge increase in potential success and potential revenue gains, it wasn't sexy enough for them. And this is what she said to me. Oh, we're looking for open banking. We're looking for APIs. We're looking for da 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 da. And I said, well, it's great, but this is a really innovative product because we've got APIs, we've built APIs, but the innovation is actually collecting the data from new sources, putting that into the processes to enable people to use it. Debt collection might not sound sexy, but actually, you know, if you look at the uptake in open banking, it sounds sexy, it sounds great. Hey, open banking, you know, it's digital. You'll be able to get information from people's bank accounts. Well, we all know the adoption of that has been terrible. And actually, the uptake of the consumer and the trust they want to give to someone else to access their bank account hasn't happened. So changing the future really is about changing the mindset of the organizations that are currently using certain data sources from the CRAs and saying, oh, open banking sounds great, guys, but it's not going to get you the instant result that you're going to get from us by identifying someone who's been online yesterday and said, I lost my job and I need £100 to pay my gas bill. That's more powerful information than the open banking piece that people don't really pick up.
Did you not think often with the new technology that comes in, there's usually a lead time between almost like the hype that's talked about, so it's like something new is being introduced, and then the use case and the case studies, and there's a gap between the two, and it takes a while for it to sort of bleed through. And I do think there's been a bit of that with open banking. You could certainly see that with the .coms, you know, video on demand, buying your books online. I mean, when that first came out, it took a while, but now we do it every day.
Absolutely.
It just takes time for some of these things to come through. Whereas I think what you're saying about what you're doing is, I mean, the infrastructure's there. It's about new data sources you can plug in to use some of the existing processes to flag it.
Yeah, absolutely. And for the collections product, that's exactly what it's there. There's new data sources that are going to show an instant uplift and improve performance. However, with our IDV product, we're certainly at that stage that you're talking about there, which is use case versus hype. Because it's still hype around vulnerability. No one's taken any action yet that's significant. None of the regulators to say, well, you're going to get fined or you're going to have to do this because you haven't done what we said you had to do. So I do think that there's that gap between use case and hype at the moment, but that will take a little bit of time to come to fruition. But companies
and I suppose with the consumer duty coming in next year, right? So it'll be that's where I'm sort of getting ready now to make sure you got your ducks in order now to get ready for that.
Yeah, the catalyst. I think there'll be a rush for the IDV product because the catalyst will be when the consumer duty actually gets finalised and comes into place. But yeah, you're right about you think Netflix. Oh, I'm never going to watch movies online. I remember using online banking and never using online banking. So I'm not going to put my credit card details in there. Now I'm Apple Pay. I just touch things and they takes my money.
Well, when Netflix used to deliver DVDs to your door.
That was it, wasn't it? Yeah.
That's right.
And you thought, oh no, never take off streaming movies online now, because you could do it at the time, but you could stream things. But it was a real hassle to actually stream things. And but like you say, as I think the difference with the open banking is it's winning over the trust of the individual consumers that nothing's going to happen to that data. The other thing I think there's a similarity actually between using open banking and admitting you're vulnerable, because as a consumer you're worried about the outcome. So using open banking as a consumer, you're saying, right, well, I'm going to give you access to absolutely everything and you're going to make a decision based on that, and I've given you it, it's open now. If you go for a mortgage, you might be able to send the bank statement you want to send and not necessarily give access to absolutely everything. Then with the vulnerability piece as well, customers don't want to necessarily admit they're vulnerable because they think they're going to get charged more, they won't get the finance, they're going to get higher interest rate applied to their loan. Actually it's the opposite. The duty of the provider is to make sure it's a better outcome, not a worse outcome for them. So for open banking, it's winning the consumer. I think that's the key to that success. But for us, we don't need to win over any consumers. They've shared their data with us, we've got it, and it's there for our customers to be able to use immediately to create those better outcomes.
Yeah, that create the better outcomes as it sort of flows through the process. Well,
Yeah.
Stuart, thank you very much
Yeah.
for making the time. I really appreciate it. As always, great insight and some really interesting nuance and some development, I think, really around like just areas of data to be able to sort of provide extra insight for consumers and for customers, really. So Stuart, thank you very much.
Yeah, thanks, Chris. Great to speak to you.